Hey there, what's up you guys? Have you ever had that feeling where you're on a roller coaster and you know that big drop is coming out of nowhere, but you're just not sure when? That's kind of where we are with the economy right now. If you've been hearing the word recession thrown around a lot, then you might be wondering, what does that actually mean for me, my money, and my future? Well, you're in the right place. In this video, we're going to break down the signs that suggest that we might already be in a recession or heading straight into one. And more importantly, we're going to share some strategies on how you can not just survive, but potentially thrive during these times. Whether you're in high school, just starting your career, or if you've been in the game for a long time, there's something here for you. First, let's start with the SOM rule. Now, this isn't something that you hear about every day, but it's one of the most reliable indicators that a recession might be upon us. The SOM rule works by tracking the unemployment rate. Specifically, it looks at whether the unemployment rate has risen by 0.5% or more from its lowest point in the past 12 months. Now, why is this significant, you might ask? Because when more and more people start losing their jobs, it's a clear sign that businesses are struggling, which often leads to broader economic downturns. Recently, the SOM rule has been triggered, and this isn't something to take lightly. Historically, when the rule flashes red, it's been a strong indicator that a recession is either already happening or is just around the corner. Think of it like the check engine light on your car. You could ignore it, you might get away with it for a little while, but you'd be taking a big risk. In economic terms, this symbol tells us that we should be preparing for tough times ahead. But what does this mean for you anyway? If more people are losing their jobs, it could mean increased competition for employment, potentially lower wages, and a general tightening of the job market. Now, it's important to be aware of this so you can start thinking about how to safeguard your own employment or income sources. Next up, let's talk about the inverted yield curve. This is yet another powerful indicator of recessions. The yield curve is a graph that shows the difference between short-term and long-term interest rates on government bonds. Normally, you'd expect long-term bonds to pay higher interest because they tie up your money for longer periods of time, which carries more risk. But when the yield curve inverts, short-term bonds actually pay more interest than long-term ones. Why does that happen? Investors are essentially saying that they're so worried about the near future that they're willing to accept lower returns in the long run just to keep their money safe. Now, this is a big deal because an inverted yield curve has preceded every U.S. recession in the past 50 years. It's one of the most reliable warning signs that trouble is brewing in the economy. For you, an inverted yield curve could mean a slowdown in economic growth, which might affect everything from job availability to investment returns. It's like seeing storm clouds brewing on the horizon. You might not be in the rain yet, but you know it's coming. This is why it's crucial to start thinking about how to protect your finances now rather than waiting until the downturn hits. Next, let's talk about the Federal Reserve, often referred to as the Fed. Papa Pow. Before we get into that, please like, subscribe, and leave a comment below for the YouTube algorithm. Alright, the Fed plays a massive role in the United States economy by setting interest rates, which influence everything from mortgage rates to credit card interest. Recently, the Fed has been raising interest rates to combat inflation, but they're also hinting at rate cuts, which could be on the way as soon as September. Now, what does this mean anyway? Historically, when the Fed starts cutting rates, it's often a sign they're worried about the economy slowing down. Rate cuts are meant to stimulate economic activity by making borrowing cheaper, but they often usually come when the economy is already in trouble. In fact, many recessions have followed periods of rate cuts because they reflect the Fed's attempt to counteract economic weakness. For you, this could mean lower interest rates on loans and mortgages, which might sound good at first, but it also signals that the economy could be heading into a recession, which might mean job losses, reduced spending, and other financial challenges. Understanding the Fed's actions can give you a head start in preparing for what's to come. It's not just the economists and financial experts who are worried. American workers are feeling the heat too. A recent survey revealed that more workers are concerned about losing their jobs now than at any point in time in the last decade. This kind of widespread job anxiety isn't just a statistic. It reflects real fear and uncertainty in the workforce. When people are worried about their jobs, they tend to cut back on spending, which can lead to a vicious cycle. Less spending means businesses make less money, which can lead to more layoffs and even deeper economic trouble. This is why the job market anxiety is such an important indicator to watch. If you're part of the workforce, this can mean that you need to start thinking about how to make yourself indispensable at work, or perhaps even consider diversifying your income streams. It's about taking proactive steps now, so that you're not caught off guard if the market takes a turn for the worse. Finally, let's talk about savings, or rather, the lack thereof. Right now, the US savings rates are at record lows. During good economic times, people often feel secure enough to spend more and save less. But going into a potential recession with low savings can mean a recipe for disaster. Low saving rates mean that many people don't have a financial cushion to fall back on if they lose their jobs or face unexpected expenses. This can lead to increased financial stress, more debt, and, in the worst case scenario, financial ruin. It's a stark reminder of the importance of building and maintaining an emergency fund, especially when the economic outlook is uncertain. For you, this can mean it's time to start taking your savings even more seriously. Even small amounts can add up over time, and having some cash set aside can make all the difference if the economy takes a downturn. It's about preparing for the unexpected so that you can weather the storm. Recessions might seem like nothing but bad news, but they can also be a time of great opportunity if you know where to look. History has shown us that some of the world's most successful businesses and investors actually found their footing during tough economic times. Let's rewind to the 2008 financial crisis. This was a time when the economy was in a free fall. People were losing their jobs, their homes, and their hope. But in the midst of all the chaos, something interesting happened. New businesses emerged that fundamentally changed the way we live and work. Take Airbnb and Uber, for example. These companies were born out of the need for affordable traveling and transportation during a time when people were looking to save money. They offered something new, a way to make or save money in a struggling economy. By focusing on what people needed during the tough times, they were able to grow rapidly, even as the broader economy shrank. This wasn't just luck. It was about understanding what people needed and meeting those needs in a new way. If you're thinking about starting a business or a side hustle, a recession could actually be a great time for you to do it, as long as you're offering something that helps people save money or meets essential needs. Now, let's look at the stock market. During the 2008 recession, stock prices plummeted, and it was a scary time for many investors. But those who understood long-term value of strong companies saw it as an opportunity. For instance, if you had invested in the S&P 500 at its lowest point in 2009, you would have seen your investment more than triple in value over the next decade. The key here is understanding that recessions, while challenging, can also offer a chance to buy into quality investments at a lower cost. But it's not just about the stock market. Recessions can also be a great time to invest in real estate. During economic downturns, property prices often drop, which make it a buyer's market. If you're able to purchase a property during a recession, you could potentially see significant gains as the market recovers. Just remember that investing during a recession requires careful planning and a long-term perspective. It's not about making a quick buck, but about positioning yourself for future success. And then there's Warren Buffett. He's often called the Oracle of Omaha for his uncanny ability to make smart investments. Right now, Buffett is sitting on a massive pile of cash. Why? Because he's waiting for the right opportunity. During the 2008 recession, Buffett made several key investments, including a $5 billion investment in Goldman Sachs. That investment paid off handsomely as the market recovered. Buffett's strategy during recession is simple. Be fearful when others are greedy, and be greedy when others are fearful. By keeping a cool head and waiting for the right moment, he's been able to capitalize on opportunities that others might miss. Buffett's approach is something we can all learn from. It's about being patient, staying informed, and not letting the fear drive your decisions. Whether you're investing in stocks, real estate, or starting a business, the key is to think about long term and look for opportunities where others see only risks. But it's not just about big businesses or billionaires. Regular people can also find opportunities during a recession. For example, many people took advantage of the drop in housing prices during the 2008 crisis. Those who were able to buy homes at lower prices saw significant gains as the housing market recovered. Others started side hustles or small businesses, recognizing that during tough times, people are often looking for more affordable or innovative products and services. So what can we learn from all of this? First, it's crucial to build an emergency fund. If you haven't already, now is the time to start saving. Even if it's just a little bit each month, having some cash set aside can help you weather the storm if things get tough. Aim for at least 3 to 6 months of living expenses. This fund will give you a cushion in case of job loss or other financial emergencies. And it's one of the best ways to protect yourself during uncertain times. Why is this so important? Because having an emergency fund means you don't have to rely on the credit cards or loans if something unexpected happened. It gives you peace of mind and financial security, knowing that you have a safety net to fall back on. Start small if you have to, but start now. Every little bit counts. Next, let's talk about investing wisely. If you have some savings and you're comfortable with the risks, consider looking for investment opportunity. Stocks are only one option, but they're not the only one. Real estate can be a great investment during a recession, especially if you can buy properties at lower prices. Bonds, particularly those issued by the government, are considered safe bets during economic downturns. Even starting a side hustle or a small business can be a smart move during a recession, as people often look for affordable alternatives during tough times. Just remember to do your research and make informed decisions. Investing during a recession isn't about making a quick buck. It's about positioning yourself for long-term success. The key is to stay calm and think strategically and focus on the fundamentals. By doing so, you can take advantage of the opportunities that others might miss. One of the best ways to protect yourself during a recession is to diversify your income streams. This means that finding ways to make money from different sources so you're not relying on just one job or business. Whether it's taking on a part-time job, freelancing, or starting a small business, diversifying where your money comes from can provide a safety net if your main job is at risk. For example, if you're good at writing, consider starting a blog or doing freelance writing on the side. If you have a skill like graphic design, photography, web development, there's always demand for these services. The idea is to use your skills to create additional income streams that can help you stay afloat if your primary income source dries up. Finally, it's essential to stay informed. Knowledge is power, and the more you understand about the economy and the market, the better decisions you can make. Follow trusted sources, keep learning, and don't be afraid to ask questions. Whether it's reading financial news, listening to podcasts, or taking online courses, staying informed can give you an edge in navigating through tough economic times. Being informed also means being proactive. If you see signs of trouble, don't wait until it's too late to take action. Start making changes now, whether that's saving more, investing differently, or finding new ways to earn income. The more informed you are, the better prepared you'll be to face whatever comes your way. All right, now that we've unpacked how the yield curve, the Fed rate decisions, and the Somme rule signal the potential onset of a recession, there's something crucial you need to keep in mind. What happens next? You see, a recession isn't just a downturn. It's a ripple effect that impacts every aspect of the economy, including how people manage their debts. And this is where things get serious. As economic pressures build, we often see a surge in credit defaults. People and businesses struggle to make payments they once could handle. But here's the thing. Understanding these early signals can put you ahead of the curve. If you're aware of how credit card defaults can escalate during a recession, you'll be better equipped to protect yourself and even capitalize on the situation. In fact, I've already covered this in depth in another video where I break down the rise in credit card defaults and the broader implications for the economy. If you're serious about staying informed and prepared, you need to check it out. Watch my video on the credit card default crisis. It should be here, somewhere. Not sure. Anyway, thanks for watching. Please like, subscribe, and I'll see you next time.